So when we think about the short end of the high yield market, and when you think about broader fixed income decisions, it's always going to be through the lens of interest rate risk, credit risk, or liquidity risk, being the three reasons a bond can move up and down in price. And I want you as investors to think about how you value those three risks and what your confidence in that those risks will be either working in your favor or against you. So let's start with some observations through my lens as a portfolio manager to share with you on the U.S. macroeconomic outlook. And right off the bat, trade war is a concern. Risk to the economies, we'll just stick to the top two. The bottom ones, I think everyone can kind of talk to, but I think the greatest unknowns right now are what is going to go from the Trump campaign trail to actual policy. And tariffs and immigration are two of the biggest unknowns that are out there. Hopefully, I can give you some comfort in what we think is likely to happen. Potential economic tailwinds, though, when you think about these potential U.S. policies, they have to be taken together and look at the whole summation of policy. Lower taxes, deregulation, energy production. This is a very pro-growth policy for the United States. Allowing more M&A, allowing more innovation, allowing companies to merge, making it easier to build homes, making it easier to have financial transactions in the United States is something that should be beneficial. And if the Fed does not cut, that's probably good for credit risk. It probably means the U.S. is growing faster than previously expected. Most of the return for investment-grade bonds is going to be dictated by interest rate risk either working for you or against you. That's the one I'm least certain about. But you can massively de-risk your investment to where you think of high yield. So if there's anything I want you guys to think about and understand, it's that there's a broader array of returns that can be defined by the time invested, whether it's short duration or long duration high yield. A lot of people's minds that have invested in long duration bonds for the last year or so because they believed rates would fall and they want to generate a higher return by having those long duration and working out for you. Short duration high yield is not no duration high yield. Investment grade bonds, when it goes down, it's usually because interest rates are rising. Well, short duration high yield bonds protect capital when that happens. But when it's positive, it's usually because interest rates are working in your favor. This strategy still produces a positive return because you own fixed coupons. Maybe not to the same duration that they have it, but you still generate a positive return. That's something money markets and floating rate cannot participate in. So it's interesting that it's not a no duration, it's a low duration alternative. And right now, I think it's very compelling when you look at the yield to worst of that short duration asset class compared to investment grade bonds and other U.S. alternatives.